Hey everybody, welcome to Trading Capital's daily analysis video. It is June 10th here, wrapping up this Friday evening. The markets were very crazy on the back of the economic data that we received today. So what did we receive today? We received the CPI, and what happened with the CPI? It continued to rise. We have not hit peak inflation yet. And we're going to be, before we jump into the reasons why we are still seeing high inflations, let's just take a look at what the S&P 500 did. The S&P 500 finished down on the day just below 2.9%. You can see this pattern was bullish for quite some time, and it broke down, clearly negated this pattern. So now it is crucial for us to wait for the next setup. Ultimately, you have found a little bit of support. If you look on the daily chart here, the reason you have found support at this wick low over here is because this was your largest volume candle for basically a 2-week period until you had this last sell-off area. So this is a major capitulation candle where a large amount of shares exchange hands and were bought at the same time. So notice how that's exactly where you have found support on the charts. So in my opinion, this chart has now turned from bullish to bearish very quickly. The probabilities do favor a continued move down in some sort of a panic selling or potentially even some sort of a over-leveraged position play, because the markets were looking to form this bull flag, which often causes traders to want to catch that breakout period, but it completely reversed on us. And in my opinion, I do think we're going to head to the low range of this channel, or at least test this low pivot over here around the 385 mark. I do think there's tons of technical damage done, but that being said, we still have the FOMC meeting next week. So it's a 2-day meeting on the Tuesday and Wednesday, the 14th and the 15th of June. We'll have the FOMC minutes come out on the first day, the 14th, and then we'll also have the long-awaited press conference from Jay Powell. So with this sell-off that has transpired, normally ahead of a Fed meeting when a sell-off occurs, it means that they're going to be less likely to jawbone the market back down. And I think what's different about this meeting is the simple fact that inflation is high. So when we look at the stock market, it has been decimated over the last 6 to 8 months, or give or take, adjust your time frame to when specific stocks bottom. But overall, within the last 6 months, the S&P and the Nasdaq have been obliterated. Down 20% on the S&P, down 30% at the low on the Nasdaq. So that is some arguably some powerful wealth destruction that has occurred already. And then when you factor in that inflation hasn't even budged from, it was around 8.2, now at 8.6% year over year. That is just saying something to the whole thesis that we are in the largest asset bubble in history. And in order for things to find a lower equilibrium and come back down to that inflation target that we were once meeting on a monthly and yearly basis, the 2% mandate, it now stands to suggest we're at a far point from ever achieving that goal, unless we have more pain in the stock market and more pain especially in the real estate market. And I think that's what the next market is to fall, is the real estate, because you have now put into the picture with so much wealth destruction occurred in the stock market and inflation hasn't even budged. You have to now assume that the real estate market has to fall in order for inflation to come lower. And with a falling real estate market, that's when I do think you'll get the energy costs to subside, because real estate has a far reach on in terms of how much energy we use, in the sense of how much commodities we mine, whether it's lumber, whether it's nickel, whether it's zinc, metals, base metals. All of those base metals require energy to extract from the ground and mine from the ground. And I do think real estate will inevitably slow enough to cause those base metals and minerals and energies to eventually slow the demand. With declining GDP, naturally energies get hit because it reduces the goods and services that are being chased. And the real estate market has been a booming industry for a long time due to the fact of low artificial interest rates and cheap money and excess liquidity floating around. So analyzing why inflation is high, if we flip to this M2 money stock, and this is the United States of America, you can see that I've broken this chart down into 6-year periods. I think that's going to be a good time frame to really break down this data and understand what has transpired. And we only really have this data going back to the 80s. So there are a few different cycles here, but starting with this most recent cycle, the money stock in 2016 has basically been growing at a rate of 12.83%. And you can definitely see by the trajectory of this graph and the movement that the last couple years since the COVID over here, March 20, the money supply has accelerated at a movement that we have not witnessed, an exponential move, so to speak. So that is very, very dangerous, and this is the one reason why we have inflation. There might be a little bit of inflation contributed to supply chains and overall the Russia and Ukraine war and deglobalization. However, the main aspect, and I would argue 90 to 95% of the inflation that we see today is direct correlation to what this increase in the money supply. And when you have a steady growth over multiple years, and you can see that it just keeps increasing the year-over-year growth, 10.91% year-over-year growth, 9.81%, 6.06%, 7.85%. So you can notice that the growth of the money supply is increasing faster and faster. And this is exactly why we have inflation. Sometimes you have to fight fire with fire. Simply raising interest rates alone will, to some degree, help inflation. However, unless you reduce the money supply, you're not going to make a dent and ever bring inflation back down to that 2% mandate that the Federal Reserve has been trying to achieve. And this is why I do think we're going to have a new norm, probably in the range of 4 to 5% if we're lucky. But until our central banks reduce the money supply, this is going to stay elevated for quite some time. When we break it down over the last 18 months, or from COVID, so 2 years now, we printed for 18 months 120 billion a month, propping up equities and treasuries. Now the Federal Reserve is trying to only reduce by 30 to 35 billion a month. So you're not really fighting fire with fire. You're kind of, reducing the money supply at a 4-to-1 less rate than what you were increasing it. So of course, in a sense, if our central banks were serious enough about lowering the inflation rate, they would focus on attacking that money supply. Just like they expanded it so drastically, they should be contracting it at a much faster rate, at arguably the same rate that you were expanding it by. You're expanding it by 120 billion a month, you should be contracting it by 120 billion a month. But the problem is our markets are so levered to the hills on credit, and that is what has driven all of this, one can say, artificial demand for goods and services. If you took that credit away, if you went back to a truer economy where there's less liquidity, interest rates would be able to normalize and find some sort of an equilibrium. But right now the money supply is just way too high, and that's why inflation is still going to continue to rise. And you can see here with the new numbers of inflation coming in at 8.62%, we're just bubbling under this trend line. And this trend line is a 100-year trend line that we're still watching. We thought we would initially peak, but you still have a little bit of room to go, which has now been eaten up. Once this number adjusts, we're sitting right underneath, right up against this trend line of resistance. So that's 8.62% exactly, is right on that trend line. And the question is now, will the Fed really start to move aggressively and potentially engineer a quicker, sharper decline or a recession? I do think there's a very, very likely scenario that we're heading into that engineered recession. And I think a lot of economists' timeline are a little bit too far out into the picture. I do think it is coming faster than people think. So now that we're reaching this long-term resistance and we're actually bubbling up under this 8.62%, the big question is, will we break out of this? If we break out of this 8.62% inflation rate, then watch out for central bank policy. They're going to have to even step up their policy up a notch, because what they're doing right now clearly hasn't reduced inflation enough. So we'll just have to continue to monitor it. And when we look at the cycles of rising Fed fund rates, the Fed fund rates have been so suppressed for years and decades and decades. And one of the interesting times that I think we're a very similar situation that we're going through, one can argue that this 1974 period over here, we had very, very high inflation, and we had the only difference is we don't have the high unemployment yet, but it could happen. But we did have high inflation mixed in with extremely high energy prices from Saudi Arabian oil. So that's obviously what we're experiencing now, is extremely high energy prices, a little bit of QT and higher rates. So unemployment is still low. So we're not in an employment crisis, but we are in a working crisis where there's not enough workers for the jobs that are there because people aren't being paid enough yet. And that's a real issue, because that's when the economy reaches that stagflationary effect where we have slower and lower economic growth but high inflation. That is the worst possible outcome, and I do think it's what we're heading into. But if you just simply analyze this, every time the Fed fund rate does rise substantially, some sort of recession or massive economic decline takes place. But the real thing is, interest rates will do some sort of damage, but reducing the money supply is going to be the ultimate kicker for how painful this soft landing is going to be. And I don't think there's going to be a soft landing when it comes to the Fed. They got us in this mess, and the only way that they know to get us out is by causing a hard landing to something that they won't be able to really control. If we take a look at oil, oil today did fall a little bit. It's still very strong. It had a nice fall down to the 118 level, and then it got bought back up kind of at the end of the day. So at least we are seeing a little bit of weakness heading into the weekend, but still very, very minimal, so to speak. Natural gas, if we flip to the hourly chart here, natural gas did have a down day. It was down minus 2.84%. So that is good to see for now. We still want to see a larger decline. The key area of support is clearly this $8 range. If we break that, I do think we see a move to the 650 area. But we'll just have to wait and see on natural gas. But I do think that overall, with a higher inflation rate, which may spook the Fed to really try to bring down inflation substantially, I do think we can see commodities take a big hit due to the scare of slowing economic growth if our central banks become more aggressive and more hawkish and start to really engineer that recession to bring down inflation. Congratulations on the winner that we closed. We banked a beautiful 14.66% on our short trade on Mosaic, so that is a tremendous way to cover it. It did go a little bit lower than our potential max profit on the day, but we did close there and cover our short, and it did rally just slightly above the level from where we closed. So an extra 21 cents above the level from where we closed. So congratulations on that short. And again, just a summary why we took this short. You had this beautiful head and shoulders topping formation. You had two neckline triggers confirmed down, and there still is more downside, but this stock has had a substantial fall all the way from 64 down to 52 in the sake of 2 weeks or a week and a half. So I do think it is time to start locking in some profits, especially when we have those double-digit gains, and especially when you are into a little bit of intermediate support here on Mosaic. So we'll just have to keep monitoring that. Our ITB short, I just want to bring this to our attention. So this is the construction ETF, and basically this is kind of supporting our thesis that we do think eventually energy is going to slow, because when you have a slowing economy, in the sense that I do think real estate is going to slow significantly, When the real estate market slows significantly on both the commercial and the residential side, that's naturally going to affect the amount of energies you need, because ultimately to mine all of the base metals and materials that a home or a commercial building requires is substantially a lot. So a lot of the demand for energies you get from the one of the largest asset and sectors in the world, which is real estate. So I do believe with the slowing real estate, you're going to see these construction ETFs come in substantially, which they already have. And this is the thing, people keep saying our oil demand has been, off the charts and we keep consuming more and more and more. Well, that is clear as day, and yes, we are. But when you look at the artificial growth of the money supply, the reason why we keep consuming more and more and more and more is because our system is credit. It's built on over-leveraged credit. So one could argue that all of this demand is actually artificial demand. And if you took away the credit, if you took away the fake artificial low interest rates and the excess liquidity that's been flowing through our economies for decades and decades and decades, then what is left? What is left when you have that true demand without the artificial liquidity? And that's the cycle that we're going to have to go through for at least, I believe, a 12 to 24 month period, as our central banks have to get a grip on inflation, because they will certainly not get back in political power based off of the majority of the people hating inflation. And that is something that we're going to have to try to wrap our heads around. But I do think these construction ETFs are going to be hit hard, just like the real estate. I mean, down 4.69% on the day. We shorted here at 60, so we're beautifully in the money. You can see this is kind of replicating the S&P 500. So I do think the S&P 500 goes much, much lower, but it'll just have to go at its own pace. And I do think at the minimum, you get back to the pre-COVID high here. And there's a massive, massive gap here at 36 that I do think eventually you will hit. And, basically it was good to be net short today. When we go flip back to the SPYs, massive, massive down day. If we take a look at Carvana, we did add a little bit more to our Carvana CVNA. And considering the markets were down substantially on the day, Carvana was pretty strong initially. I mean, if we flip to the intraday chart, there was a period here that Carvana actually had a massive rally up. And we added over here around the 22.16 level. And Carvana, we were actually in the money just from that add. And the fact that the markets continued to sell pretty much all day and Carvana held up relatively well, I mean, it did finish a little bit down. If I was short this position, which again, remember 50% of the float is short, I would be tremendously scared that Carvana did not fall substantially more. Let's take a look at the energy short that we just issued yesterday. So Cenovus Energy CVE, you can see here that we shorted up at the 24.44 and we've had two beautiful consecutive down days of sell pressure. At the minimum, you come fill this gap around 22.69. If you notice on the intraday chart, you did have a little bit of a sell-off late into the day that isn't reflected yet. So it's good to see some of the plays that we picked up additionally are starting to falter here. Archer still had a relatively flat day. It did have a little bit of a sell-off in the morning. We are in the money on Archer. Our average is at 439. So it's good to see that Archer is now trading at 408 in the post-market hours. So we are in the money substantially. I do think at the very minimum, you fill this gap here at the 349 level. There is a substantial amount of volume that you have to eat through and get through here. But with a hard down day in Archer, you could chew up that volume pretty quickly. If we take a look at gold, gold had an impeccable day. This is exactly what we want to see. So essentially, gold had this initial dump in the morning. It broke your key 25-day moving average. I remember looking at it in the morning, and then it rallied and had a substantial rally all day and never looked back. Up 1.24% on the day. That is tremendous rally for gold. The fact that you're now trying to close above these little closing highs over here, and in fact you actually did on a closing basis close above the previous high close over here. So that is just something interesting to note. You do have this potential breakout in gold forming. It is too early to tell, but you could argue that tomorrow or Monday will be confirmation day for gold. And this is interesting because if you flip to the how strong the US dollar was today, look at this power move on the US dollar. And let me just say, the US dollar and gold typically have a 97% correlation to when the US dollar rallies, gold typically sells off, and vice versa. And the fact that they're both rallied together, it just shows you that the inflation narrative is taking a little bit more of a dominant stance. And even with rising rates, typically that's bearish for gold. But again, it's showing you that inflation is really starting to scare people. It's starting to become a hot topic, and it's something that politicians will have to, and central bankers will have to get a grip on, because it is notorious high inflation levels for causing severe stagflationary environments, or severe economic pain when inflation stays elevated for too long. And that's why I do think the Federal Reserve will have to be a little more aggressive. Let's take a look at Bitcoin. Bitcoin has had a massive sell-off today. If we take a look at where we're trading, we're still stuck in a range. So even with the hard economic data today, we haven't really broken out of the same range that we've been trading at. Versus if you analyze the S&P 500, the S&P 500 broke out of that bull flag range, and it's trading much, much lower to roughly the lower range. So there's still about a 50-50, Bitcoin could still move up, but it's finding it very, very difficult to believe that Bitcoin's going to make a move here, because it's been struggling and struggling and struggling. The last hope is maybe you have a retrace back to this original breakout zone. That'll kind of be the telltale sign to see whether or not we hold that level, and whether or not we close below this lower orange boundary over here. So there's lots to consider and lots to watch. I do think next week will be pivotal. Monday might be a low volume day. You may see some continued selling due to the fact that I think there's going to be a lot of nervous investors. The investors that maybe didn't sell at the end of the week thinking that there's going to be a continued bounce may start trimming back positions even more ahead of the Federal Reserve, and potentially ahead of the Federal Reserve becoming more hawkish. That is certainly a possibility now. We were kind of expecting, if the markets rallied, you're going to have a hawkish Fed. But most people were expecting inflation to come down. That inflation CPI number is not good for the markets, and it certainly caught a lot of people off guard. And I think it's potentially going to catch the Fed off guard, in the sense that they're going to have to address it somehow. And the fact that we're already trading at the low ranges of support in many stocks, as well as in the S&P 500 and the Nasdaq, now we're approaching that double bottom, those tweezer bottom zones. Time is of the essence for these markets. We're at some pretty crucial inflection points here that I do think is going to be very interesting to trade around. So we are net short the market right now, but I would still prefer it if we saw maybe a continued rise in some names. Some of our tech plays that we've been holding, we probably could have sold out of a couple and take more profits, like Netflix. But I do think that Netflix, and the likes of those names that have been battered 70-80%, still potentially have a little more upside and gas in the tank. So we'll just have to keep monitoring that. And just summarizing the sectors today, every sector was down on the day. The strongest sector was consumer staples. Consumer staples, likes of Costco, Walmart, and we're still in Walmart, so it was good to see that despite in a down day, Walmart still had a pretty strong move to the upside. So you can see here Walmart is significantly off the lows. Our average here is at 123.26, and it's still a very small position. But I do think the likes of Walmart can potentially still have a rally. That was a substantial move down. I still think there's a potential to fill this gap here at the 131 level. But decent to see that consumer staples were the strongest sector. The financials were rocked today, as well as the, let's just go through the list here. The consumer discretionaries took a massive, massive beating, and obviously technology. I think if we take a look at Amazon was pretty impressive today, in the sense that, let me just switch to the actual Amazon chart here. Let me remove all these lines. So Amazon took a beating today. It was, out of all the big cap tech, one of the worst ones on the day to fall. And clearly you can see that Amazon has filled not only one gap, but it gapped over that gap. It did fill this gap, and now it looks like it's approaching this 106 gap down here. It's just so weird to say 106 with this reverse split that's gone, or the stock split that's gone. But in the sense that you filled a couple gaps now, you also created a new one. So the big question is, for the markets, are we going to get some sort of a relief rally Monday before the Fed jawbones the market back down by being more aggressive? Or are we going to get just a continued sell-off down to these lows over here, and then potentially get a little more of a relief after the Fed speaks, and then continued downside? So there's a lot. It's too difficult to tell right now which direction it's going to go. On a technical basis, the charts have had extensive damage done. In my opinion, it does favor slightly more downside, but you have had 3 hard days of selling now, and that is something to certainly take note of. So that's it for tonight. We'll continue to monitor crypto over the weekend. It's a good thing we took that Chainlink position off the table, because Chainlink was down, I think, over 10% today at some point. So good to see that we took that off. Too bad we couldn't pull the Bitcoin profits off yet. It's still holding that key support, as well as Ethereum, but I have a tight stop loss on Ethereum and Bitcoin over the weekend. Ethereum is around the 1600 level that I'm going to have a stop loss at, but we'll just have to monitor it over the weekend and see what transpires. Thank you all for being members. I wish you have a great weekend, and please hit that like button below and subscribe. We need all the help we can get. Thank you again for being members. Take care.